What's the better strategy for early retirement? Dividend investing or growth stock investing? On one hand, dividends can provide a steady income stream, while on the other, growth stocks offer the potential for significant capital gains. So, which one could help you retire early? Well, let's dive in and find out. First, let's dive into the two big strategies in the investing world: dividend investing and growth stock investing. If you're into dividend stocks, you're all about the consistent cash flow. Think of it as getting paid just for holding onto your shares. Whether the market is up, down, or sideways, dividend investing keeps earning money. It's like having a steady income stream that doesn't care about the daily stock market drama. Now, this is where things get interesting. Growth investors, on the other hand, are in it for the thrill of watching their investments soar in value over time. They're not focused on getting cash payouts. Instead, they're all about that sweet capital appreciation, seeing their stocks rise in price and banking on the potential for big returns in the future. But we'll look deeper into that shortly. Dividend stocks are typically more established companies. These are the giants that have been around the block and know how to keep things running smoothly. Sure, they're still growing, but they're big enough to share a portion of their earnings with you, the shareholder. Take Coca-Cola, for example. It might not have been the explosive growth potential of a tech giant like Amazon, but it's a global powerhouse that consistently pays out dividends. Now, dividends aren't a guaranteed payday, but there are plenty of companies with a solid history of reliable payouts. Let's say you invest $1,000 in a dividend stock. The stock price might go up or down, but you'll still be getting that cash quarterly, like clockwork. And if you're smart and reinvest those dividends, that's where the magic happens. Your money starts to grow and compound over time, like a money tree that just keeps getting bigger. The only way this stops is if you sell your shares or if the company decides to stop paying dividends. On the flip side, growth investing is all about capital appreciation. As a growth investor, you're betting on a stock's price to skyrocket over time. You might buy a stock because you believe it's undervalued, or maybe the company's financials, market trends, or competitive advantages have you convinced it's a winner. Growth investors can vary though. Some might hold onto a stock for just a year or two, while others are in it for the long haul, holding on to their stocks for 20 years or more. But here's the thing with growth investing. You're more exposed to unrealized gains and losses. Let me break it down. Let's say you invest $1,000 in a stock and over 5 years, it grows to $5,000. Sounds great, right? But then the day before you decide to cash out, the market takes a nosedive and your $5,000 shrinks to $3,500 in just one day. Ouch! Those $4,000 in gains you were dreaming about, they're suddenly down to $2,500. With growth investing, your gains aren't real until you actually sell your shares and cash in. It's a roller coaster ride, and you've got to be ready for the ups and downs. But, well, both dividend and growth investing have their unique advantages and challenges, depending on what you're aiming to achieve. But how do you decide which approach, or combination of both, is right for you? That's where portfolio allocation comes into play. Let's take a closer look at how you can balance these strategies to align with your personal goals and financial situation. When it comes to balancing your investment portfolio between dividend and growth stocks, the strategy really boils down to your personal situation and goals. Now, if you're chasing those high, short-term returns, you'll often find them in small-cap growth stocks. These are the young, scrappy companies that can skyrocket after a market correction or crash. But here's the catch. They're also the most volatile, so they're closely tied to the overall mood of the market. It's like riding a roller coaster. You're in it for a wild ride, but the payoff can be huge if you time it right. On the other hand, mid to large cap growth stocks are the safer bet if you're thinking long term. These are the companies that have already proven themselves and have a solid track record. They might not have the same explosive growth potential as the small caps, but they're more stable, making them a great choice for building wealth over time. Now, let's talk about dividend stocks. These should be your steady companions throughout all the market ups and downs. Whether the market is booming or busting, dividend stocks keep delivering. The price at which you buy these stocks, not as crucial. Why? Because they're generally less volatile, and their real power comes from their ability to grow dividends over time. You're not just investing for the capital appreciation, you're in it for that sweet, reliable income stream. So, what's the smart move? Ideally, you want a mix of both dividends and growth stocks in your portfolio. The exact percentage depends on where you're at in life, where your age, income, and financial goals all play a role. For example, if I were 24, making $60,000 a year with plans to retire at 60, I'd load up my portfolio with small, medium, and large growth stocks. Why? Because I've got time on my side, and I can afford to ride out the market's ups and downs. But if I were 50, pulling in $300,000 a year and looking to retire in 10 years, I'd shift gears to focus more on dividend stocks. This strategy would likely lead to a safer, more predictable retirement, especially when you can really see the power of dividend investing with a larger pool of capital. Balancing dividend and growth stocks in your portfolio is all about tailoring your strategy to fit your unique situation and goals. Whether you're seeking the high returns of growth stocks or the steady income of dividends, finding the right mix is key. However, understanding how these strategies stack up against each other in real-world scenarios can give you even more clarity. So, let's take a closer look at specific examples, like Okta and Tesla, to see how growth stocks compare to dividend stocks in different market conditions and what that might mean for your investment decisions. Let's talk about growth stocks, and I'll start with a prime example. Okta, OKTA, is a cloud software company that's all about managing and securing user authentication for modern applications. It's a company that's been making waves in the tech world since its founding in 2009, but it only became available for public trading in 2017. Now, because Okta is still in the early stages of its growth journey, it's focused on innovation and expansion. And here's the thing, Okta doesn't pay dividends, and it probably won't for decades, if ever. Why? Because every dollar they earn is funneled back into growing the business. So when does this make sense to be a growth investor? Well, if you're young and you can take on more risk, growth stocks can be incredibly appealing. They offer the potential for higher returns that could outshine those steady dividend-paying stocks. If you're the kind of investor who's looking for big gains and isn't afraid of a little volatility, growth stocks might be your jam. But there's another big perk: taxes. As a growth investor, you don't have to worry about paying taxes until you're actually selling your shares. This can be especially advantageous if you're investing for the long term, particularly in tax-advantaged accounts like a Roth IRA. In those accounts, you could potentially watch your investment grow tax-free until you're ready to cash out. But the real allure of growth stocks is the chance to invest in companies that are set to disrupt industries. Think about Tesla, TSLA, a company that turned the auto industry on its head. If you believe in the potential of innovative companies like that, growth stocks might just be the way to go. Sure, it's a bit of a roller coaster, but the potential for substantial gains makes it worth the ride. So, if you're a younger investor with a higher risk tolerance, or if you're just someone who believes in the power of disruptive innovation, focusing on growth stocks could make perfect sense. The potential for higher returns, combined with the tax advantages, makes growth investing an attractive strategy, especially if you're playing the long game. But let's not overlook the power of dividend stocks, especially when the market gets rocky. The best dividend-paying companies have a knack for continuing to issue dividends even through recessions, though some might cut back a bit. But why is that? Well, here's the thing. Dividend investors tend to hold onto their stocks for the long haul. These companies are generally well established, with less downside risk compared to the more volatile, cash-strapped growth stocks. When the market crashes, dividend-paying companies often have an easier time bouncing back. Their stability comes from their strong foundations. These are often blue-chip stocks, the big names with multinational brands that are well diversified within their industries. So while growth stocks might be more exciting, they're also more volatile and often rely on just a few products or services. That's why when the market takes a hit, dividend stocks don't crash as hard and are more likely to recover. Take the ProShares S&P 500 Dividend Aristocrats ETF, NOBL, for example. It tracks a list of companies that have consistently grown their dividends for 25 years or more. Now, while these dividend aristocrats might not always outperform the broader S&P 500 index, they have a much easier time rebounding after a severe recession. Growth stocks, on the other hand, might never fully recover after a big market downturn. Another reason why market crashes aren't as scary for dividend investors is the opportunity they present. During a crash, dividend yields often start higher, and stock prices are usually more attractive. So if you're buying during a downturn, you're getting in at a lower price with a higher starting yield. This could mean a better yield on cost over the years compared to buying during a bullish market. So, when does it make sense to be a dividend investor? If you're looking for steady cash flow or prefer investing in more established companies, dividend stocks are the way to go. They're especially appealing if you're older, more adverse, or if you have a larger amount of capital to invest. And if your goal is to retire early, living off the dividends could be your ticket to financial freedom. Dividend investing is one of the best long-term strategies you can use if you're seeking a relatively consistent stream of income. It's also the smarter choice if you're not into taking big risks, have a good chunk of money to invest, or if you're aiming to retire early on the dividends you receive. So, which strategy do you think will get you closer to early retirement? Consistent dividends or the thrill of growth stocks? Drop your thoughts in the comments below, and let's keep the conversation going. If you found this video helpful, don't forget to like, subscribe, and hit the bell for more amazing videos like this one.